Okay, good evening, dear friends. Welcome to our webinar tonight. So before I start, I would like to do a sound check. If you can hear me clearly, please tick yes in the poll. All right, great. I have seen most of you guys tick yes already. So first of all, I hope you guys know you're amazing, as you could have gone having fun or chilling at this hour, yet you are here with us to pick up more knowledge. Rest assured, all of us is going to learn and get back something very valuable tonight from Mr. David. So let us together discover the golden opportunities in the gold and silver market. I'm your host of the night. My name is William Law from Phillip Capital Sdn Bhd. Throughout this webinar, if you have any question, do not hesitate to type them into the question box so I could forward your questions during the Q&A later for the speaker to answer before the webinar ends. So don't be shy. Okay. First thing first, this presentation has not been reviewed by Securities Commission Malaysia and is provided solely for general information and learning purposes and does not constitute any recommendation. We are not liable for losses arising based on this information. So kindly seek advice from qualified advisor or dealer before making any investment decisions. We have them all around and you can reach to us easily at Phillip Capital. Here, allow me to have a brief introduction to our new friends here tonight. If you're a first timer to join our webinar or is your first time knowing us, Phillip Capital Sdn Bhd is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd, which is our mother company from Singapore. We are incorporated since year 1995. Our headquarters for Phillip Capital Sdn Bhd is based in Kuala Lumpur, and we currently have branches across Malaysia at Kota Damansara, Melaka, Penang, Johor, and in East Malaysia, we have it in Kuching and Sibu in Sarawak. And we also have Kota Kinabalu's branch at Sabah. Next, Phillip Capital is a legit trading and clearing participant of Bursa Malaysia Derivatives and Clearing Berhad, as well as a holder of Capital Markets Services license. So on last year, we have the overall best retail and best institutional derivative trading participant awards from Bursa Malaysia. So tonight, Phillip Capital would like to take this opportunity to extend our biggest gratitude to our clients. We are not achieving this without the great trust and support from our clients. Here, our mother company, Phillip Capital, has footprints and branches established widely over 15 different countries. As you can see from this map, we have office over these 15 countries as pointed out. In Phillip Capital, we are covering products listed at numerous exchanges such as Singapore Exchange and the popular CME, CBOT, MYMES, and then Hong Kong Exchange and more. With our global coverage, clients are easily accessed to trade both local and foreign products within a same platform that we offer. Okay, so let's take a glance on our products available at Phillip Capital Sdn Bhd. The two main products we are currently offering are futures trading, which consists of these interest rate futures, indexes, and then energy, agricultural such as crude palm oil, which is known as CPO, and metal futures such as gold. And secondly is contract for difference, which is known as CFD. This one is for stock traders. These CFD products offer a very attractive margin requirement, so you may talk to us anytime to know about more. As for tonight, our webinar will be sharing about metal futures, which is related to gold and silver. So why choose Phillip? So first thing, Phillip Capital's headquarters is 24 hours available for broking and execution support. This is one huge comfort for clients who trade foreign futures, whereby there's dealers that could assist on your enquiries or handle your issues at any time. Next, we send out latest market news and market commentaries to our clients through email on daily basis. And we also provide advisory service to the enquiries on what kind of products you are looking to trade and how you can get started in trading. And we provide wide range of products in our trading platform that enable clients to trade both local and foreign products easily. So at Phillip Capital, we too offer free one-to-one coaching sessions, free seminars and webinars, and free account opening. All you need to do is to fund in minimum 1,000 to activate your account, and the money can later be used for trading. Feel free to reach to us at any time. So for this, our one-to-one coaching session, which is free, we target on the beginners. We cover an introduction to futures trading to understand the trading products better, and surely our own trading platform coaching as well, as to understand better and set up your own charting system. If you do need this kind of coaching, do not hesitate to reach out to our representative. Next. Okay, we have launched the first futures trading online account opening in Malaysia. You can now open futures trading account online easily with us. Feel free to visit our website or scan the QR code, and it will link you directly to the online account opening. The process is not complicated. Basically, it will just take you 10 minutes to fill up the necessary details and upload some required documents, and it will be processed in shortly. If you need any guidance on online account opening, please do not hesitate to contact us. Next, our platform for futures trading is called Phillip Nova. You get to access to the global trading products here. So there's two ways you could do your trading. Firstly is the desktop version. It's a web-based platform which gives you a very nice and professional view. And for the mobile version, you trade through the Phillip Nova apps, which allows you to trade easily and anywhere, anytime. You may now try to scan or screenshot the QR code here, and to register for a free demo account, may try it out. Okay, I'm moving on to next. And you can find out our Phillip Nova mobile app from Google Play Store or from App Store for Apple users. You can execute trades, get all the live charts, and view your profit and losses summary inside these apps. So now I'm going to talk about a little regarding our ongoing promotion for futures trading. So our currently ongoing promotion is to trade CME micro futures at only $2.5 per transaction. It means per in out the round trip is only $5. So basically with this, you can trade micro US indexes such as micro contract sized Nasdaq, Dow Jones, micro S&P, silver, and US Treasury yield at a very low rate per lot size. So micro-sized products margin is usually 5 times, 10 times smaller than the usual standard contract, which provide a lower entry barrier for traders and a more manageable risk contract size for starters. Because a $2.5 rate, traders can easily break even for their trades and get into profitable state. So you may scan this QR code to register, or you may as well contact our dealer representative if you have any inquiries on this promotion. So lastly, here's the little introduction of our dear speakers tonight, Mr. David Ng. He's a full-time proprietary trader with IcebergX Sdn Bhd. David Ng has done extensive research and is well versed in the commodity and index markets. So he currently trades the Malaysia index and CPO and other regional markets. He is well versed in the technical and fundamental aspects of trading. So previously, David was the derivative specialist with a prominent futures broker. In that role, he provided regular comments on the market to local media like The Star, Business Times, and The Edge. So without further ado, now let's welcome Mr. David. It's your time now. Mr. David,
hi,
welcome.
Yeah, thank you for the kind introduction. Just a quick sound check, William. Are you able to hear me?
Yes, I can hear you clearly. Yes, Mr.
Yeah,
David.
are you able to see my slide as well?
Yes, I'm able to.
Okay, thank you very much, William. So once again, just like to thank Phillip Capital as well as CME Group for inviting me to speak on this platform entitled "Discover Golden Opportunities in the Gold and Silver Market." You know, it's given this kind of market condition, discovering opportunities, especially golden opportunities, is kind of ironic, because if you just look at, we've been following gold prices, you probably have seen, you know, gold has made a high of 2,000 US dollar per ounce, and it went from then on, it can never recover. So it's quite ironic that, you know, you try to find golden opportunities, but nevertheless, I think given this kind of market conditions that we're in, I think it's very suitable, and it's definitely an opportune time for you to be looking into gold and especially the precious metal space, the gold and silver market. So just before I start, as usual, a risk disclaimer. So anything I mention here in this webinar is purely for educational purpose. So you know, any examples and any examples that's highlighted here is purely based for explanatory purpose. And opinions are purely my own. It doesn't reflect any opinion by Phillip Capital or indeed by the exchange. And dealing with futures does involve risk, as mentioned by William earlier. So make sure you do consult with a licensed representative before you start your journey in trading futures. So I think these are some of the key things that we'll cover in this webinar tonight. I think mainly is, you know, is a lot of people is wondering, you know, despite, you know, economy is getting uncertain, you know, there's risk of recession that's been talked around. Why isn't gold not performing as it should be? I think there is a lot of play, there's a lot of interplay, there's dynamics that's going into the space. So which later I'm just going to shed some light into it. And I think it's important for us to discover some of the key developments, especially in the gold market. You know, I think much should be seen. You know, this year the team is recovery team, especially with 2 years into the COVID-19 pandemic. So I think really is, you know, the theme for the economy in general is recovery. And true enough, I think just these 6 months, you know, we have seen commodity prices rally, and I think it's going to be very volatile going forward. And nevertheless, I think gold as well as precious metal is going to enjoy the kind of ride. Now, I think it's important for us to read some of the market sentiments that is related to gold, especially if you're trading the gold market. There's always certain key economic developments that's worth to pay attention to. You know, if you are trading this space, you know, economic data, economic news is very relevant. So I think just later part 8:30 Malaysia time, we're going to have the US CPI numbers, which I think is highly anticipated. So I think that's going to create a bit of movement, especially in the precious metal space and in fact in the equity space as well. Last but not least, I'm just going to cover a little bit on technical analysis. I think just share with the audience today some of the key simple technical strategy that you can use, especially when you're looking into the precious metal market. Now, just to give you a brief background, you know, on where we are coming from. I think really the world this year, as I mentioned earlier, you know, this year we're looking at recovery. So I think we started off the year with high anticipation, but I think eventually, you know, with the Ukraine-Russia conflict started in the first quarter, I think really it took a turn. Now, in fact, I think a lot of major international economic bodies are forecasting the global economy is going to hit into a slower growth. So that's quite unusual. You know, despite we start off the year thinking that, oh look, the world economy is going to recover, we're going to have higher growth. But as we head into at least the first half, really I think the dynamics has changed. Ukraine-Russia conflict actually exacerbated some of the key supply chain, and therefore actually fuel inflation going forward. So really I think, you know, growth is likely going to be quite slack going to the second half of this year. Predominantly, I think you look at US and China, I think those countries are starting to show sign of weaknesses. This is quite evident, and I think it's important because when you have a global economy that's not growing as expected, I think, you know, a lot of central banks are starting to step on their toes. And really, I think if you just look at inflation being a key driver, it's really going to change a lot of dynamics. So if you just look at commodities now, I think 2022 is also a year of commodities. So you probably have seen, if you are trading the Malaysian space, you probably have known you trade the palm oil market, we are hit as all-time high 8,000 ringgit per ton. But since then, I think prices has actually plunged to a level at 4,000 ringgit. And it's not only restricted to palm oil. You look at other grains market as well. A lot of these major commodities has actually retraced some of their gains. And keeping in mind, commodities is a major theme this year because of we have shortage of supply. Demand is actually quite robust going into the year. By then things start to change. So really, I think commodities is very well driven. But looks like the momentum has actually faded. Now, if you look at gold, for example, I think gold, despite commodities in general has actually dropped, but gold dropped fairly little as compared to other commodity basket. So in a way, despite commodity in general has been dropping, gold fare a little bit better in a sense that it actually dropped much less compared to other commodity basket. Now, I think going into, since I was talking about global economy, I think really, if you just look at some of the key data and key statistics, it's really pointing you that the global economy is indeed showing you sign of slowing down. So obviously, if you just Google, the word recession, I think it's going to pop up a lot of articles. I think generally a lot of major international bodies, as well as some of the key prominent, financial personnel, they are indicating that the global economy is indeed going into a recession. So with that in mind, I think really, everybody is finding for a safe haven to park, or rather asset class to park their money. Unfortunately, in historical perspective, every time when a global economy hits a recession, there's always a flight to safety, and that is always gold. But later on, when I show you a couple of slides later on, you should see that I think that role has started to fade. I think this time the money flow is going to asset classes that we have not imagined before. So I think really, in the viewpoint of a recession, I think likely the global economy is going to hit into a possible recession probably in the next 6 to 12 months. And if you just look at some of the surveys by some of the key economies, I think they are indicating that economy is indeed going to slow down quite tremendously, at least for the next few quarters. Now, if we I mentioned here, you just type the word recession on Google. Really, I think the hits are getting higher. So really, I think everybody, the talk of town, the buzzword is, is recession here, or is it coming? So I think one of the key indications is really look at corporate earnings. As long as corporate earnings are showing you sign of growth, at least the recession fear can be tamed. But as earnings starts to show you decline, especially corporate earnings, that's usually a sign of concern. That tells you that generally, I think the economy is going to hit further south. And that's where it's going to worry us. So as long as corporates are still making money, earnings are still quite robust, I think the fear is still can be quite tame. But if earnings starts to drop, which is quite evident right now, if you just look at some of the companies in US, especially in Europe as well, they are showing you sign of weakness in terms of their earnings. So I think that's where it's going to be a major weakness going forward. So if this trend continue, I think likely that the recession fear is going to be here to stay. Besides that, I think some of the key economic indicators are also pointing you that in fact the economy is actually slowing. If you just look at PMI, which is a very good barometer, which everyone is looking at it. Every time when you have PMI above 50, usually indicates that the economy is going to grow, or manufacturing is expanding. Anything below 50 usually shows you contraction, which is kind of bad sign. But if you just look at some of the numbers, the latest numbers coming from some of the key countries, especially in Europe, Germany and France being the very large Europe economy, it's just fascinating that their PMI is actually starting to decline since the early part of this year, and it's not showing you sign of any growth in that. Keeping in mind, just today, I think you've just read the news. Euro trading to a US dollar on a parity basis. So I think this will put a lot of pressure on European economies. So with major economies around the world starting to show you sign of weaknesses, I think that should be a point of concern. And I think that's why a lot of people has been talking about the risk of recession in recent weeks. So not only restricted to France and Germany being a large economy. If you just look at US and China itself, the PMI numbers are also showing you, despite they are staying above 50, but really the trajectory is showing you on a downward trajectory. That tells you that economic activities are still going on a downtrend. So these are some of the factors that's also supporting the argument. I think really if you just look at construction in terms of China, demand for steel, it has been quite sluggish. Coupled with that, I think China COVID zero policy is very restrictive. You just look at some of the key news that's happening just a couple of days back. I think one in cities of Shanghai is actually starting to have a fear of being locked down just because cases start to rise by just an over 20 or 30 cases so far. So with that in mind, I think really if China COVID zero policy is actually very restrictive policy. So anytime when cases start to flare, you start to see the fear of being locked down, and that will have an impact in terms of China economy. So I think really, some of these key economic barometers are pointing you that economy around the world is actually starting to slow. Despite we have high vaccination, COVID-19 fears have started to subside a bit, but nevertheless, I think economy in general has not been performing as to what the market expect. Now, I think another key major concern is obviously inflation. We are feeling it domestically as well as international perspective. So I think just early part of this year, we saw food prices be on a sharp rise. If you just look at grains and much to our home, if you just look at palm oil prices, it's actually hit an all-time high. So really that fueled the concern of rising prices, and inflation was a major topic. But then again, I think just a short span of a couple of weeks back, we start to see commodity prices start to adjust. If you just look at palm oil, for example, we went to as high as 8,000 and now it adjusted to probably between the 4,000 ringgit region. So that shows you at least 50% retracement. So a lot of these major commodities starts to decline and start to retrace some of their gains. Eventually, this is just purely based on my personal observation and opinion. Inflation would take is quite sluggish and it's quite sticky. But eventually, if prices can stay at this level, certain key commodities starts to stay at this level, I think inflation should not be a major concern. As long as food prices are starting to stabilize and normalize, I think we should see inflation level to start coming down. I think that will be a good news. But nevertheless, I think that will take a period of time. It won't be an immediate effect, despite we are seeing oil prices starting to normalize and certain grain prices starting to normalize, but that has not translated into general price level. So I think that's also another major concern. So really, I think going to the second half, that's going to be a major thing that's on everybody's mind, especially on central banks, is what's the level of inflation. And if you have a high level of inflation, that's going to be a major concern. Now, with that in mind, with that economic picture in mind, really how is gold has been performing? If we just look at some of the common narrative, if you just look at gold, there's always a saying, gold is always a safe hedge against inflation. If you have rising food prices, there's always a famous adage, don't buy food, buy gold. But really, I think if you just look at gold prices and you just compare that against the US CPI inflation, which is a indicator of a general inflation in US, really, I think we see kind of a positive relationship back in early 2020 when you see rising inflation levels in US. It actually coincided with the rising prices in gold market. But that relationship has actually since been diverging. Right now, I've seen inflation reaching almost 8% in US markets, but gold has not been climbing. So really, I think the role of gold as a hedge against inflation is actually being challenged at this point in time. So really, I think as an investor or someone that's looking at gold as a potential hedge against inflation, I think that really you have to look at the current dynamics that's in play, especially in the gold market, which actually making it quite suppressing the gold prices, and therefore breaking some of the common linkages that we used to link gold with. Now, if you just look at, I think one of the major reasons why gold actually diverged in terms of their performance is because if you notice, the US federal fund rates are starting to rise. This is in response to higher inflation. Keeping in mind, I think in the next couple of series of FOMC meetings, it has it was quite accommodative that US Federal Reserve will continue to hike interest rates, probably in the region of 50 to 75 basis points as aggressively as they can to tame down the inflation. So with that in mind, with inflation going up, with federal fund rates going up, it's actually making gold less appealing. I think that's one of the major reasons why gold during this time could not be a good hedge against inflation. Keeping in mind, we have been in a low interest rate environment for a very long period since the 2008 global financial crisis. Since then, we have not seen Federal Reserve hiking up to above 2 or 3%. But this time is slightly different because inflation is very menacing. So therefore, I think US Federal Reserve has no choice but to increase to hike interest rate as fast as they can. So with that in mind, I think gold being just an asset that do not yield any interest with rising interest rate environment, there's always other asset classes that's more attractive. And in this example is the US dollar. So you can clearly see US dollar has actually strengthened tremendously. And it's also actually affecting some of the key emerging market currencies. So with that in mind, I think one of possible narrative is that with Federal Reserve increasing their interest rate is actually making gold less appealing. Now, if regards to the question where is gold still a safe haven, in time of crisis, I think gold does play a role of a safe haven. If we just look back in 2020 when we have the start of the COVID-19 pandemic, it was a health crisis. So we saw gold play its role. In fact, gold climbed to as high as 2,000 US dollar is an all-time high. And since then, I think it retraced. So in times of crisis, whether it's economic crisis or health crisis, gold still remains a very relevant asset in terms of protecting its value. But in general, I think if you just look at over time, whether it's a very good asset against protecting just a general economic downturn or general economic softness, I think gold still, in that sense, doesn't really play much of a very big role. If you take away crisis out of the equation, and just given a normal general economic condition, I think gold may not be a very suitable asset when it comes to protecting your assets, especially in equities market. So what I have here is you just look at the chart. You compare, the Dow Jones against the gold market. Obviously, 2020 was a sharp nosedive for the equities market just because we have the COVID crisis. Like I mentioned, I think in terms of crisis time, really gold is very prominent. But when you have an economic slowdown, which is not a crisis, then gold may not be in favor because generally I think economic slowdown is just a temporary setting. Eventually the market will pick up again. But it's a different story if the economy is facing a crisis. So important question to ask for ourselves is, if we want to answer this question, is gold still a safe haven? Really, the question we should ask ourselves is, are we in a crisis or are we going to foresee a crisis? If that's not the case, I think gold will still remain very sluggish, and it may not be that attractive as a safe haven. Now, I think really, if you really want to see shocks in the economy, look at some of the key indicators like your VIX index. VIX index is, at most times, it plays a role of being a fear gauge indicator. So you just look at back in 2020, if you just look at the VIX index itself, during the start of the health crisis, we saw VIX climb as high as 80 points. And every time when it's crisis like this, it usually prompts people to really rush into safe haven, and therefore I think gold benefited in that sense. So really right now, you just look at VIX index, although it's quite elevated, but it's not a point of concern. Obviously, if VIX continue to climb, it tells you something. But right now the reading is still generally quite fair. It's about 25 to 30. It's high if you compare on average, but it just tells you that generally the market is not fearful enough to generate interest in to change asset classes or to change your asset flow into safe haven assets like gold. Now, another indicator that's similar to VIX, which is what we call a put call ratio, which measures the amount of put against the amount of open call positions. Now, how do we interpret this? I'm not going to go too deep on the dynamics of it, but just a basic understanding of it is basically whenever we have high put call ratio, that tells you market generally is quite fearful. So again, you can clearly see right now the levels are quite elevated, but it's not a point of concern. So if you just trace back in 2020, we saw a big spike because that was the start of the COVID crisis. So really, I think gold plays a very important role, especially during time of crisis. Now, this is fine. I find this table quite interesting in the sense that if you compare the S&P 500 returns against gold, you notice that historically speaking, over the past 30 or 40 years, every time when the S&P 500 doesn't perform, and in fact when it went into technical bear, definition of technical bear is when the index fall below 20%, on a relative basis. Generally gold perform well. If you just compare back in, just to draw an example, I think back in 1974, we have the recession. S&P 500 was down by 30%. Gold, in fact, climbed positively on 4.7%. So at most times when there's a downturn in the equities market, gold actually came in and performed very well. Now, surprisingly, I mentioned this year, 2022, is a different story. So for investors or traders who really base their trading perspective on historical perception, you must take note that historical doesn't always give you or doesn't project into the future. So like I mentioned, I think the dynamics in the gold market has changed. So despite we are seeing downturn in S&P 500, we also see the same parallel in the gold market. Really, I think this time now, because of money flow is moving out of major asset classes, and gold doesn't give you the kind of interest because it's a non-interest yielding asset. So really, I think a lot of money flow is flowing to other asset classes. So as a result, we are seeing both markets start to face decline, especially during the height of the interest rate cycle. Now, technically speaking, if you just look at gold, if you just look at comparing it against the 200 exponential moving average line, I think prices are actually trading below, which tells you technically the market is on a downtrend. So as long as prices are trading below the 200 EMA, it tells you the market generally is on a downtrend. So later on, I'm just going to share with you some of the simple strategy that you can use. What this tells you is that gold, when it's a downtrend, we should be in a position of, or we should be finding opportunity for us to short the market rather than finding opportunity to long the market. Because once the trend is in place, try not to fight against the trend. Now, despite all the negative narrative that's accustomed to gold, but if you just compare the precious metal space, if you compare other metals like silver or platinum or palladium, in fact, I think gold holds very well. Although they are down year to year, but if compared to silver or platinum, which is down more than 10% on the year-on-year basis, I think that's even more. If you talk about absolute value, that's more serious. So I think really, gold still remains as a class that's, despite it being trading on the downside, the quantum of it is actually still quite minimal as compared to other metals. So I think one way to track, if you are trading a gold market, just go to World Gold Council. They have always a monthly report. If you just want to have a basic fundamental understanding of where the gold market is or what is the gold market current play, just go to World Gold Council. They have tremendous reports that you can read, and I think those are very useful, especially when you try to paint yourself a long-term picture of where the gold market is going to head. Now, I'm not going to touch too much on some of the key fundamentals of gold because I think the fundamentals of gold are actually pretty balanced. It's unlike other commodities where you talk about grains, you talk about food. There's always a period of high supply, low demand, and whatnot. For gold, generally the supply is fixed. You don't suddenly see a big surge, in supply because one miner decided to mine aggressively. You don't see that often. And demand picture is slightly different. Again, I think you don't see that kind of big surge in is very rare. So the demand and supply dynamics of gold is actually quite balanced. But nevertheless, it's important for us to understand and to track, especially if you just look at China and India being the two largest, buyer of gold, whether it's for jewelry, whether it's for central bank purchases. you can't discount that China and India are very big markets. So if their markets are not doing well, maybe economic situations are afflicting them, generally gold demand will actually be quite on the lower end. So that will have an impact on gold prices. But keep in mind, I think just for understanding, really if you want to look at gold demand, just have a look at China and India, because these two are the largest economy when it comes to the demand for gold. Now, in terms of supply, I just want to put the Ukraine-Russia conflict into perspective. So, just early part of just first quarter of this year, we saw the start of the war between Ukraine and Russia. I think that really took a toll in terms of the supply of gold. So I mentioned earlier, the mining supply for gold is actually quite limited. Like I said, miners don't simply just mine aggressively just to increase supply in the market, because they know that there's always a fixed supply of gold on the ground. You can't just miraculously create more gold out of thin air. So really, I think that's in terms of how the supply dynamics for gold market. So I think really Russia is a very big player in the gold market, and because of the Ukraine-Russia conflict, it actually aggravated some of the key countries to start boycotting some of the Russia gold. I think that really took a hit. So in fact, I think some of the association, especially in Europe region, they are starting to not take Russia gold. In fact, they are trying to take from other region. But keep in mind, I think if you look at the supply dynamics, Russia is actually quite a big player in the gold market. They probably contribute at least 10% of total gold supply for the whole market. So if you discount Russia, you talk about there's going to be a very tight market situation in the market. So I think eventually, despite all the talk and news of people boycotting Russia products, as a response to the Ukraine-Russia conflict, we can't really discount Russia's supply in totality, because they are a very big player when it comes to the gold market. So it's important development, I think, especially if you're going forward, especially the ongoing developments in Ukraine-Russia conflict, it's going to create a lot of news flow into the gold space, and that will actually create a volatility in terms of the prices. Now, the reason I put up this chart here is to show you dollar strength against gold market. Like I mentioned earlier, I think because of Federal Reserve keep increasing interest rates, really I think the appeal of US dollar has started to come back. So if you just look at some of the key currencies, just for example, look at euro. Right now they are doing parity 1-to-1. So really I think that's really telling you the strength of the US dollar. So I mentioned this always a narrative between a trade-off. When you have a high interest rate environment, there's always an appeal to go into US dollar, and therefore there's no appeal to go into gold just because it's a non-yielding asset. So that's what you're seeing right now. We see interest rates starts to rise, US dollar start to strengthen, and gold as a result tend to be disfavored in that sense. Now, I think the only good end in the whole narrative of this is that inflation is still quite persistent. Now, if you compare, historically speaking, whenever you have high inflation levels, if you just look at the treasury yields, the real treasury yields when you factor in inflation, actually gold perform very well. In fact, that's the reason why people say that gold has been a good hedge against inflation. But the story has changed, I think, right now. If you just look at the dynamics of it, it seems that because of the high interest rate environment, really, I think people are more appealed to other asset classes. But much to be seen. Can this relationship still hold? Personally, I think it's still quite possible that when you have inflation that's going, as high as 8%, 10%, really that's going to push people to really look into some of the other asset classes that can be a good preserve of value, and in that sense I think gold could be quite a good candidate. So I think again, you just look at inflation story against gold, is whenever high inflation environment, normally you tend to favor gold, but the question is really because gold is always an asset classes that people view that you don't get much of a return, there's no interest return, so really I think when you have high interest rate environment, gold will always look less appealing. Now, this is a quite interesting scenario. What we have here is basically the copper gold ratio against the US Treasury yield. Now, if you just look at historically speaking, and if just based on historical pattern, every time when copper gold ratio starts to reach a peak, normally it peaks first before the peak in US Treasury yield. Now, why is this important? Now, the copper gold ratio tells you, copper is a very important metal when it comes to economy. That's why it's called Dr. Copper. Why is it called Dr. Copper? Is because when you want to know the health of the economy, just look at the copper performance. If copper is not doing well, generally the economy is not going to do well. Because there's less infrastructure spending, there's less economic movement, it demand less of copper, therefore the prices have to come down. So when this ratio starts to decline, that tells you that generally the economy is not doing well, and generally the economy is actually heading on a downturn. Historically speaking, when this copper gold ratio peaks earlier, normally it peaks about 6 months in advance. Then after that, the US Treasury will start to peak. Now, whether this is going to happen this time round is much to be seen. But the copper gold ratio has actually pretty much peaked in early part of this year. So the question we need to ask ourselves is, will Treasury yield start to peak? Now, what scenario will Treasury yield start to peak? I think the one clear example is that when inflation starts to decline, and when economy really go into very sluggish mode, when central bank is starting to get very worried about US growth, I think that's where Treasury will start to peak. So do watch out whether this copper gold ratio against the US 10-year Treasury can show something relevant, and whether historical repeat itself. I think very likely right now, I think the copper gold ratio is indicating to you that the global economy is starting to slow down, and I think therefore it's going to affect you going forward. Now, I think this is also interesting in the sense that if you just look at if you want to compare yields, US Treasury, what we have here is comparing the US 2 years and the 10 years Treasury yield. Whenever you have an inverted yield whereby the current yield is the current yield is way lower than the further periods yield, that normally be telling you there will be a sign of recession coming into play. So right now we're seeing is that yields are actually approaching to negative territory again. So I think that's foretelling you that the economy is going to head into a possible recession. And every time when yield starts to go negative, you start to see rates coming down. So is that a question that US Federal Reserve fund rates, despite the call of hiking aggressively, will they come to a point where rates will start to come down? There is a possibility. We can't discount that. I think that's what if just based on historical pattern itself, when yields are telling you that it's going into negative territory, I think really the interest rate cycle will also start to be mindful of, and it will start to decline as well. Now, I'm not going to go too much on this chart. Basically, it tells you the price difference between the second active month against the first active month in the gold futures contract. I mean, there's relevance to it to show this because it tells you whenever the difference between both months starts to get wider, that means the expectation of interest rate is going to go higher. Keeping in mind, the gold market, if you are trading a gold futures market, if you notice every single contract that's listed on COMEX market, the forward contracts, those prices, they always trade higher than your current month prices. Reason being is because there's always what we call cost of carry, and the cost of carry for gold is always positive because of the interest rate factor. So whenever you have wide gaps between two different contract months, especially 1 month against the other month, subsequent months, it tells you a lot of dynamics. It tells you a lot of picture. Basically, the market is factoring in or expecting that the interest rate will go even higher in the next couple of quarters, which is quite in line with what the market is expecting. I think people are talking about 75 basis points is quite given, at least for the next couple of meetings. So I think really this is an important dynamic to take into the picture, especially when discussing about how gold is reflecting the interest rate element from the market participants. I think again, just to show you how really when you have a high interest rate environment, it's usually not a good time for gold. just because I think people will find it that gold doesn't give you any interest. It's better for them to park in other asset classes. Now, besides that, I think it's important for us, especially when trading gold, is to look into money flow. And when it comes to gold money flow, we always look at the ETF flows. So whenever you see high flows going into gold ETF, that tells you there's always generally a high demand for gold. We saw this in the early part of 2020 at the start of the COVID pandemic. We saw huge inflows into the gold market. So therefore, I think you can clearly see why prices climbed from $1,200 right as high to $2,000. But since then, I think generally the inflows and outflows are actually quite balanced. Until recently, I think the last 2 months we saw consecutively outflows into from the gold market. So really, that's telling you that if you want to see the change in trend, you must see a change in the ETF flow. So if you try to foresee or you try to make a prediction when the gold market will start to see a change in trend, pay close attention to the gold ETF flow. So once that flow has been actually reversed, I think usually that could tell you that probably that's the start of a new trend in the market. Now, besides looking at ETF flow, if you're trading the gold market, it's always important for us to look at positions. This is what we call net positions in the market. So generally, I think if you're trading the COMEX market, generally the market is still a net long market. But the problem is that the participants who are holding long positions in the gold market has actually starting to decline. Usually that's a cause of concern, because in a market that if you have lower participation, especially during a trendy market, that tells you the strength of the trend. So right now, I think generally if the positions are still net long from the market participants, but generally the overall position has actually started to decline. So it's very difficult for the market to see a rally if you look at the net positions are starting to decline. So hopefully going forward, as week goes by, we start to see at least this position starts to normalize. But keep in mind, this COMEX, usually COMEX exchange or rather CME exchange will usually report on a weekly basis what are net long and net short positions in the market. It's important for a trader to actually assess the sentiment of the market through this method, because that will actually tell you whether generally the market participants are bullish or bearish in the market. Again, I think when you have a trend and when your open interest starts to decline, that tells you generally the market there's not much market participants in the market, and therefore the trend really is going to be trading on a sideway, or if there's a trend in the market, probably that will tell you a lot of people are actually coming out taking or clearing their positions in the market. Now, if you just look at in terms of price performance on a seasonal basis, if you compare on a monthly basis and you just look at the historical data, I think gold generally performed well towards the end of the year, especially during the November-December period. But if you just look at June, July, which in fact is, if you look at June itself, is actually a weak period in the gold market. True enough, I think last month the gold market on a monthly basis actually was down by 2%. July seems to be quite a strong month, so let's see, we are only halfway into the month. But August seems to be a stronger month because again, I think India and China, especially India, as they get into the Deepavali season, normally they'll demand more of gold market. So really, I think August is a strong month, but September, October is quite mixed. But heading towards the year end, normally you see gold prices tend to be stronger. So if you are trading on gold market, it's good to have a seasonal pattern in mind, so that at least you know which are the periods that you're entering in that is stronger and which are the periods that you're entering that is weaker. So just to reflect the previous chart in a better manner, really you can see red boxes are indicating you month-to-month change in red, green boxes are month-to-month change in green, higher. So can you clearly see that around year end and beginning of the year normally are strong periods in the gold market. So because that's where festive season starts to come, Chinese New Year, normally there'll be strong demand for gold, especially as it heads towards the Lunar New Year. Now, I think pretty much of this webinar I talked a lot on gold. but didn't really cover much on silver. So I think therefore, I think it's important for us to look into the gold and silver ratio. Now, I think there's always a ratio between both markets. Despite both are in a precious metal space, silver is always trading at a very good, very steep discount, given the fact that the nature of the silver market itself. Gold is more relevant itself as a store of value. People view gold as really as something exotic. Silver is more of an industrial metal, but nevertheless, it still plays its role like a precious metal. And now, if you just look at the ratio itself, normally in terms of the average ratio for gold and silver is about 80. It did break a high, I think back in early 2020, where gold actually traded a very big premium compared to silver. In fact, silver was actually quite undervalued. So, if you are someone that's trading on ratio, normally the trading method will be mean reversion. You're hoping that you catch the extreme of the move, hoping that given time the ratio will probably normalize to its average. So right now, if you just look at the ratio itself, it's actually quite balanced. It's trading above 80. That's where its normal historical average is staying. But it's still fair to say that silver has a bit more potential in terms of price upside, given the fact that if you talk about relatively price performance to gold, it seems like silver looks to be a bit more. It looks cheaper compared to gold. If you talk about relatively speaking, so really, I think you just look at ratio itself. It shows you a lot of upside in terms of silver market. But nevertheless, I think when you have to look at the fundamentals of both. And really, if there's strong rally, there's strong demand for gold, I think generally silver will benefit. But again, I think the ratio is indicating that gold is trading at a slightly a bit more premium compared to silver. So do take a look at silver. I think there's a bit of potential there. But then again, it really depends on how the whole market dynamics is for the precious metal. I just want to share a little bit relevance here. I know these two commodities they don't have a very close relationship before this, but quite uniquely, I think just in recent times you start to see that crude oil and gold start to display quite a similar pattern. Like I mentioned, I think it's pretty much an outflow across commodity space. Doesn't matter which commodity classes it is. I think generally a lot of investors or managers are moving out of commodities or pretty much locking in their gains. But nevertheless, if you're just trading on looking at patterns, I think clearly you can see there's a little bit of similarities between crude oil and gold in terms of their price performance in recent times. Now, silver market I think is still quite bearish. If you just look at if you want to look at a technical chart perspective, silver is still trading below the 200 period EMA, which tells you that generally the market is still on a downtrend. So really, I think silver market it doesn't find any hope much when it comes to the technical perspective. It is still trading below the 200 period EMA. Now, I think besides looking or using 200 period EMA as a way to determine whether the market is trading on an uptrend or downtrend, and if you are a trend trader, I think it's important for you to add to your trading tools another good indicator is called ADX. So for those who are not familiar with ADX, it is an indicator to show you the strength of the trend. So anything that is above 20 reading, it tells you that generally the market is trending. But anything below 20, that tells you actually the market is going sideways, or rather the trend is actually start to decline. So really, you look at it, I think there's a bit of trend in the gold market, and the trend is actually showing you downside because it's trading below the 200 period EMA. So there's a bit of opportunity, when it comes to finding position for you to short in the gold market. So do watch out. If ADX continue to climb, it's a good indication that the trend in the gold market will continue to decline. Now, of course, obviously, identifying the overall trend of the market is important because that will tell you whether should you be finding position to long or short. Like I mentioned, I think as a trend trader, it's good that always be trading on the overall trend of the market. So clearly you can see gold and silver market is actually clearly on a downtrend. It's good to find opportunity for you to short the market. So Hagen, one of the ways to find a perfect entry execution in terms of finding position for you to enter and exit is one of the ways is to look into using Heiken Ashi as a derivation of Japanese candlesticks as a way for you to time your entry and exit in the market. I think it's, in a way, if you compare to Japanese candlesticks, is simpler in a sense that now if I want to look at whether the market is on a downtrend, I just look at the color of the candles. So if the color of the candles are red, that tells you generally the market is still on a downtrend. So if the market is a series of green and red candles, normally that tells you the market is sideways market. So sideways market, you can't use a trend trading strategy. You have to either wait out the market to break from the range, or you can use a sideways trading strategy. That is out of the discussion today. But again, I think when it comes to trend, Heiken Ashi is a very good way to identify that period trend in a particular moment. Now, if you couple Heiken Ashi with crossovers, moving average crossovers, I think that will be quite a good entry and exit strategy. So crossovers are quite easy to use. Normally, we always pair with two types of two periods crossovers. I think the period that I use is the 9 period comparing against the 20 period EMAs. So 9 period is always considered the faster moving average, and the 20 period EMA is usually considered the slower moving average. So whenever we have bearish crossovers, it simply means that the shorter moving average, the shorter period, is moving below the longer period. So that tells you generally the market is going to be on the bearish mode. And if you couple with that with red Heiken Ashi, that gives you a quite good signal that generally the market is going to go on a downtrend. So again, if you see red Heiken Ashi bars and you see a bearish crossovers on a moving average, it's actually quite a good entry, good position for you to enter a possible trade. So same goes, you can wait until the candles turn from red to green to exit, or you can see whether the candle starts to break the moving average itself. Either position, that will be a good entry for you to exit your particular trade. Again, all these scenarios I mentioned, do make sure that you do test run on it. You do make a test scenario before you start trading or start using it. Same goes for any strategy that you employ. You make sure that you do a proper test run on some of these strategies. Now, last but not least, I think with every trade setup, it's always important for you to make sure you must have a stop loss in place. Less important is actually the profit target, but really is a stop loss. Now, given that the market conditions are like this, it's so volatile these days, so really important for you to make sure that you have a proper stop loss in place. So one of the ways to use stop loss is another indicator that I always use for stop loss is what I call ATR. It's basically an average true range, which measures the daily range or the particular period range for the particular asset class. So if you look at the ATR value for gold, in this example, is actually 30 points. So if you just look at the signal on the chart itself, you have a red Heiken Ashi, you have a bearish crossover on the moving averages, is a good signal for you to short the market. So assuming you're short at 1760, so if you work on a 2-to-1 reward to risk based on the ATR value, you would be looking at 60 points as your target and 30 points as your stop loss measure. So in this example, 1700 will be your target profit level, and your stop loss will be at 1790. So that's how we use ATR to actually maneuver your stop loss position. And it's important and it's critical that every position that you enter, you must have a stop loss plan in place. Without a proper stop loss plan in place, technically you're exposing yourself to too much of a risk. So since we are in a gold market, I think one of the best exposure that you can get yourself, especially when you dabble in a gold market, is the futures market alone. And I think CME is a very deep market. It offers varieties of contracts and exposure, especially when you talk about a gold market. So do speak with Phillip Capital representative on finding out more information on the specific gold contracts that's available for you to trade. So this is what I have a chart on the micro gold contract. So itself, you just look at the volume of open interest, actually quite deep. I think on daily basis, you're talking about easily about 60 to 70,000 contracts traded on a micro gold. So it's actually a very deep market. So there's no issue of liquidity. So you shouldn't be worried about getting in and out of the market. So coming to the end of my webinar, I think really the longer trend for gold and silver is actually suggesting further downside. We just look at technical perspective, as well as some of the key fundamental dynamics we just shared earlier on. Now I think silver looks like the unlikely candidate to display more weaknesses compared to gold, given the fact that the ratio is actually pointing higher and higher, which shows that gold seems to be outperforming silver by a big margin. Now, economic uncertainty and monetary tightening definitely will be a key theme, and with rising dollar, it's going to make gold less appealing in the short term to medium term. So as long as central banks continue to hike interest rates, I think that's going to be a major appeal for dollar itself, and that's going to make gold in a way less appealing. So the important question is gold still remain a safe haven asset? Now this again, and I mentioned what you are seeing in the dynamics of gold is really the fund flow. Fund flows are moving out of commodity as a whole, despite whether you're talking about crude oil, whether you're talking about grains, or whether you're talking about precious metal, they're all moving out. And I think they're moving into other asset classes, and in one respite is definitely on the US dollar currency. So again, I think with that in mind, really if gold can, whether its role as a safe haven, is really depends on whether the condition of the economy, are we going to head into a possible crisis, or not? Is it going to be a prolonged slowdown? Normally in a prolonged slowdown, gold may not be a good candidate. But if we're talking about a possible crisis, which again is unpredictable, then I think gold's role as a safe haven asset is still remain relevant. So I mentioned, I think prices respond well to a crisis, but may not be good in an economic slowdown, which we are all experiencing right now. So with that, I'm just going to pause here for any question and any questions that the audience may have. And I'm just going to hand it over to William.
Okay, so thank you, Mr. David, for your valuable kind of expertise and very insightful views and sharings. Tough time indeed we are in, so everybody might have to stay alert and watch out on your portfolio and tradings as we seek for the trading opportunities carefully. So now let's proceed with Q&A from the floor. Participants, you may keep the questions coming in, and we'll try our very best to answer all the questions. So now for the first question, we have the question from Mr. On. So his question was that, what is your take since gold does not perform in correlation with US dollar, and what does it mean, and what does it tell us?
Mr. Yeah, that's a very good question. Thank you for the question. Now, yeah, I did mention in a lot of my slides, the co-relationship between gold and US dollars actually, is diverging. In fact, some of the gold relationship with other variables are also starting to diverge. What this tells you is that, very simple, the money flow is actually leaving the commodity as a whole, and it's leaving gold altogether. So really, I think the key question, which I highlighted at most time, is the strength of the US dollar. If US dollar continue to strengthen because of the US interest rate continue to hike up, I think that's going to have an impact in terms of gold. But like I mentioned also earlier on, there bound to be a period where once the economy starts, or US economy starts to show sign of dramatic shift or decline in terms of expectation and sentiment, I think eventually the Federal Reserve will have to slow down on their hiking interest rate. In fact, they may even cut interest rate. Then by then, we hopefully can see gold to come back in the limelight. Obviously, right now, it doesn't seem to be the case because interest rate everybody is expecting it to go much higher level because of inflation. So I think just because of that, the relationship between gold and a lot of other major variables starts to break.
Okay, so thank you, Mr. David, for the answer. And so we have another question, which is, when commodity prices are coming down, are we heading into stagflation?
Okay. So generally, when commodity prices are coming down, it's indication that demand picture is likely to be weak. So generally, that's usually a telltale sign that possible, the economy is going to get weaker. Now, recession it is quite imminent. Now, stagflation is a different story. Whether are we possibly heading into stagflation? I would say the likelihood is not that high yet, but it's worth to pay close attention to. So stagflation is something more serious. We're talking about economies stagnating, and when you have persistent high inflation. So as long as commodity prices, especially if you look at crude oil prices, is actually start to taper down below the $100 per barrel, I think that tells you it actually take a bit of hit out of the whole inflation theme. So as long as commodity prices starts to come down or starts to retrace, I think that will put a bit of pressure downward on inflation. So the risk of stagflation will actually start to be minimal. But if inflation is uncontrollable, if commodity prices, despite where it is right now, and economy starts to decline on a rapid basis, then I think the risk of stagflation is actually very real. And I think that's going to have a major impact on a lot of asset classes. Maybe in that regards, I think gold could come into the picture, and I think gold could play its role, especially when you have a series of stagflation.
Okay, thank you, Mr. David. I think that will be all for our Q&A session because I see there's no more question coming in. And due to time constraint, perhaps I have to. So the sharing session is over. So now I will be taking over and sharing with, get back to the promo for once before we end this session. So this is our currently ongoing promotion. Besides gold, actually for the gold, we also have the current promotion is at USD $3 only for trading micro gold. Yeah, so there's another one promotion. So for this promotion is to trade CME micro futures at only $2.5 per transactions. It means for the round trip is only taking $5. So basically with this, you can trade micro US indexes such as micro contract size Nasdaq, Dow Jones, micro S&P, and silver. Yeah, silver and US Treasury yield at a very low rate per lot size. And the micro size products margin is usually 5 to 10 times smaller than the usual standard contract, which provide a lower entry barrier for traders and a more manageable risk contract size for starters. As at this rate, $2.5, traders can easily break even for their trades and get into profitable state. Again, you can scan this QR code to register or to directly just contact us, our dealer representative, if you have any inquiries on this promotion. Okay, so if you find our webinar useful, you may try to stay connected with us on Facebook, Instagram, LinkedIn, or YouTube by just searching Phillip Capital Sdn Bhd, and Telegram by searching Phillip Capital. Do like and follow our page. There's valuable freebies that we consistently update, like podcasts, our events, promotions, announcements, and latest market news on our social media. So our recorded video will be uploaded to our YouTube channel too. Do subscribe us. And this is our branches contact. If you have any queries, please do not hesitate to contact us through any method of your convenience, be it phone calling, email, website, or just directly live chat us on Facebook Messenger. And our representative will respond to you in very short while. With that, I will end the session for today. So we appreciate everyone for your time to join our webinar today, and many thanks, of course, to Mr. David Ng for his expertise and insightful sharing. So good night, everyone, and happy Wednesday. We will see you very soon. Thank you.
Thank you, William. Take care.
Thank you, Mr. David.